Hello, my name is Nur Nazima binti Jafri. My matrix number is BB19110765. Today I'm going to present topic 4, which is improving financial stability. The regulatory process may not always work very well, leading to banking crisis. Asymmetric information leads to adverse selection and moral hazard problems that have negative impact on financial system. From the existing problems, financial regulations were brought to prevent them from getting worse. Basically, there is 10 financial regulations. The first one is government safety net. It is conducted to give support to financial institutions and protect them from any losses. Next is restrictions on asset holdings. Often promotes diversification, which reduces risk by limiting the dollar amount of loans. The third financial regulation is capital requirements take two forms. Banks' leverage ratio must exceed 5%, and Basel Accord suggests that banks must at least hold capital at 8% of their risk-weighted assets. Next is prompt corrective action. The FDIC could ask institutions to submit a capital restoration plan or restrict their asset growth. Under financial supervision, proposals for new institutions are screened to prevent the asymmetric problems. On the other hand, assessment of risk management provides bank examiners with methods to supervise risk management systems. The seventh financial regulation is disclosure requirements. Basel II emphasized disclosure requirements. Banking institutions has mandating increased disclosure of their credit exposure, amount of reserves, and capital to increase the market disciplines. Next is Consumer Protection. Consumer Protection Act of 1969, Truth in Lending Act. All lenders are required to provide information to consumers, such as the cost of borrowing, including the total finance charges on the loan and a standardized interest rate. Other than that is restrictions on competition. Glass-Steagall Act, repeated in 1999, is more on focusing the prevention in competition that involving banks and non-bank institutions by engaging in banking business. Lastly is macroprudential versus microprudential supervision. Microprudential stress either the institution satisfies capital ratios or not. Meanwhile, macroprudential ensuring that the financial system has a sufficient liquidity. In conclusion, the existence of asymmetric information has turned the financial system upside down. However, financial regulations have been developed in order to reduce moral hazard and adverse selection problems. All the regulations protect customers from financial fraud such as unethical mortgages, credit cards, and other financial products.